hear about correlations and how the dollar gold correlation isn't working like it used to. Want the gold, right? And they want the silver too. They're just not as vocal about it yet. So those correlations we have contended are not broken. Those correlations are suspended while the market, again, recalibrates, rebalances at higher levels. Okay. Normalcy will return after gold and silver are at their proper price. So they contend the correlations will return as tailwinds once things get balanced again. So what they're saying is the dollar's strong and gold's not going down. When the dollar gets weak, gold's probably going to go up, isn't it?
The historical negative correlation between gold and the dollar suggests that a strong dollar typically leads to a lower demand for gold. The current correlation between the dollar and gold stands at 0.32 and is expected to increase further, reinforcing this inverse relationship. With a wealth of experience and a track record of accurate predictions, VinceLanci is a renowned financial analyst. VinceLanci's analysis in this video suggests that while correlations between the dollar and gold may appear disrupted, they're expected to normalize as the market adapts to higher price levels. Gold is trading at all-time highs after breaching levels not seen since the yellow metal's dramatic rise and fall in the 1970s and 80s. From a technician's perspective, Vince underscores that major central banks like China report relatively low gold reserves, up to 4.5%, while the true extent of their holdings may be higher. He notes a trend of nations acquiring gold, suggesting a strategic move due to the current economic climate. Last year, China increased the gold portion of its central bank reserves to about 4%. Beijing views gold as a geostrategic security investment, aiming to reduce reliance on the United States and, consequently, on the U.S. treasuries. While discussing the influence of yield curve control on currencies, Vince mentions its effects on the Japanese yen and how it may foreshadow similar effects on the U.S. dollar. He cautions against inflationary risks associated with these policies, citing recent fluctuations in the yen's purchasing power as evidence. In early trading, as Asian markets opened on April 29th, the currency plummeted to a 34-year low of 160 to the dollar, adding to its hefty fall against the greenback over the past 3 years. Following that, Vince explores the relationship between Bitcoin and gold, noting that Bitcoin cannot replace gold as a hedge against inflation or uncertainty. Concurrently, he acknowledges the limited exposure of asset managers to gold and silver, suggesting substantial growth opportunities with increased allocation to precious metals. Now we present the clips of VinceLanci's insights from his recent video with Arcadia Economics. Before we continue to delve into this discussion, please subscribe to our channel and activate the bell icon for timely updates.
A couple charts for you. There's like 30 charts in here, but here's a couple that I thought were worth showing. Official sector gold buying. So the orange is official sector, means central banks or sovereign funds. All right, so you can just see it's going up. 2024 is actually lower so far, but that's because the price is much higher. Next chart. Some major central banks have a low percentage of their reserves in gold. Take a look at China at 4.5%, it looks like roughly. Now, their central bank reserves are a low percentage in gold terms. Now, that's the official number. We know China has a lot more gold than that. But what they're getting at is, see all these countries that are, let's hope, being honest, the UK, Australia, India, Switzerland, Japan, Singapore's got more gold than that. Saudi Arabia has more gold than that. UAE has more gold than that. Brazil, Korea, they're all buyers of gold. If everyone else is buying gold, they're going to buy gold. And there's a lot of validity to that. Asset allocation to gold. Asset managers have a ridiculously low allocation to gold or gold exposure, right? To silver or silver exposure. Now, that doesn't always mean futures. It doesn't always mean GLD or SLV. It also means miners. How low is it? Well, that's 1%. These guys are in the 0.6%. What are they, 30% in tech, 50% in tech? Give you an idea of how much upside there is when somebody says, you know what, I think I'll buy a little bit of gold today. Next chart. This chart is an example of the decoupling or reintermediation. That's the word they use, right? Yeah, reintermediation. It's basically like saying crypto is not a hedge for disaster anymore. So if you look in this area here, 21, 22, crypto, the blue line does extremely well, volatile, but extremely well relative to gold. And that correlation is fictitious, I'm telling you, but it certainly was something to pay attention to. And people were saying, well, gold is being replaced by Bitcoin. Silver is being replaced by Bitcoin because this is when the inflation started. It's also when the stimulus check started. So this was not Bitcoin being a hedge for gold. It was Bitcoin participating with meme stocks at the time. Now, here we are in 2024, and you have gold doing what it's supposed to do at all-time highs. Bitcoin also doing quite well. That's probably, again, because of another external factor, and that is the floodgates are being open and the ETF is listed. But anyway, the point is, this was the aberration. Maybe the future. Use yield curve control, and one way or another, it's going to weaken your currency. And look, if you're shooting a gun in a crowded room, someone's going to get shot. Okay, if you're throwing a bowling ball at pins and there's gutter guards out, you're going to hit some pins. Okay, so if you're using yield curve control to keep your long end rates low, you're going to make your short end drop. That's just how it works, okay? Inflation manifests in the currency. Now, this is also very important towards China. There's a lot of implications here. Put it this way, the yen has been historically the Asian dollar. It's been the reserve currency. So I think what's happening to the yen will happen to the dollar, maybe not as dramatically, but eventually. Give you an idea, in the last week, the Japanese yen has lost, I don't know, between 4 and 7% purchasing power. So that's like going to the store and seeing prices go up in a week, 4 to 7%. That's after going up 7% over the last 2 months. So if it starts to feel like hyperinflation, yeah, it's not hyperinflation, but that's the whole concept. The concept is you get your money, you expect prices to go up, you go out and buy shit before prices go up, which makes prices go up.
Looking at CPI for the 30 years from 1989 to 2019, the average annual inflation rate was 2.5%. The Federal Open Market Committee, the arm of the U.S. central bank that makes decisions about managing the nation's money supply, targets a 2% inflation rate over time. Meanwhile, VinceLanci underscores his earlier prediction regarding the inevitable rise in inflation targets. He anticipates adjustments to these targets to align with increased spending levels, foreseeing inflation rates of 3 to 4% amid efforts to maintain low unemployment. The U.S. inflation rate is 3.5% for the 12 months leading up to March 2024. The rate of inflation was up 0.4% in March from the previous month, according to the latest release from the Bureau of Labor Statistics. Despite current disruptions, Vince stresses the importance of a weaker dollar for supporting export-driven economic recovery and maintaining America's global competitiveness. Let's get back to the interview.
Inflation targets will be raised, something we've also said here many times. Footnote, we say a lot of things here, say them a couple of times, and then as they start to happen, we stop talking about them. We're not talking our book. We're not selling advertising space. It happens, we move on, right? But everyone's catching up now, and that's really kind of cool. So inflation targets will be raised. Whatever they're saying now, they will say something else later. And before they change what they're saying now to what they're saying later, they will start to permit things they didn't otherwise permit. Inflation's going to float at 3 to 4% if the federal government keeps spending. I don't care what what Powell says. Unless you're changing the numbers, you can't get inflation down to 2% with unemployment this low. Low unemployment means high inflation now, meaning the economy is a three-legged stool. The GDP, how it's doing, unemployment, and inflation. And if you continually lower two legs, the other leg's got to drop. If you continually raise two legs, the other leg's got to raise, or the whole thing tilts and doesn't work. Okay, so we've had low unemployment for a long time. We've had low inflation for a long time. Okay, and we've had high GDP. Well, the GDP is now higher, and the unemployment remains low with the inflation high. So either people have to get fired or inflation comes down. If people get fired, GDP comes down. If inflation gets lower, GDP comes down. The point is, what was equilibrium is no longer. Correlations will return. We talk a lot here about correlations and how the dollar gold correlation isn't working like it used to. The dollar's strong, gold is up. Why is that? It's because of the war. It's because of this. It's because of that. No, it's because they want the gold, right? And they want the silver too. They're just not as vocal about it yet. So those correlations we have contended are not broken. Those correlations are suspended while the market, again, recalibrates, rebalances at higher levels, okay? Normalcy will return after gold and silver are at their proper price. So they contend the correlations will return as tailwinds once things get balanced again. So what they're saying is the dollar's strong and gold's not going down. When the dollar gets weak, gold's probably going to go up, isn't it? Okay, the dollar sells off, and that's one that we all know, but just to put a finer point on it, that's mercantilism. We need a weaker dollar to export. If we don't export stuff, we're not going to recover. We're not going to hold our place on the world stage.
Taking a retrospective view of gold's price trajectory, we note that the precious metal has doubled in value since 2016, when it hovered just above $1,000. This substantial appreciation underscores gold's enduring strength as a financial instrument, mirroring shifts in investor sentiment and broader economic trends during this period. Given VinceLanci's perspectives on currency fluctuations, gold reserves, and inflation, how do you anticipate adjusting your investment portfolio to capitalize on opportunities in the current economic climate? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.